Good morning, traders. It's Wednesday, September 17th, 2014, 8 a.m. Chicago time. Derivatives trading involves substantial risk of loss and is not suitable for all investors. My personal opinions, market data, and recommendations subject to change without notice. Past performance is not indicative of future results. So looking at what could possibly drive the markets today, well, overnight, UK July ILO unemployment came in lower than expected, 6.2% versus 6.3%. Small boost for the UK. The Bank of England ministers voted in line with expectations, 7-2 votes for 7-2 rates and 9 versus 0 for QE. Saw evidence pointing to Q4 slowdown, insufficient evidence of inflationary pressures in the future, considerable degree of uncertainty on how much slack is in the economy. The Eurozone August CPI came in higher than expected at 0.4 versus 0.3 estimated. Sorry about that. U.S. General Dempsey cannot rule out a wider role on the ground for U.S. troops in Iraq versus ISIS. Obama's policy was not to use direct combat on the ground. But basically, U.S. General Dempsey says that they may expand. They're looking to expand the U.S.'s role, the coalition's role on the ground. The Scottish referendum vote, which is huge. Poll out says 52% on the no side, 48% on the yes side. There were 4 other polls that showed similar results. Some significant volatility is expected in all UK asset classes and currency pairs on a victory of either side, the yes or the no camp. This is very important to watch. I believe a couple of the news feeds that I use are actually having extended service through this process. I expect some volatility, so I'll be watching the markets overnight. The People's Bank of China announced yesterday it will provide 500 billion yuan in liquidity to banks. It gave us a small pop. That was a pop from 76.50 ES, 76.50 to about 82 before Hilsenrath came out and talked about the Fed becoming more dovish in their statements. Yesterday's session priced in lower fears of a hawkish stance by the Fed later today. And then this morning, interestingly enough, U.S. CPI numbers for August, month-on-month, came in at negative 0.2% versus 0.0%. This caused a quick pop in the ES from about 89 a quarter to about 93.50. So basically, the entire range of the overnight session was on this CPI announcement. Year on year coming in at 1.7 versus 1.9. Why is this important? Again, FOMC meeting today at 1 p.m. Central. The CPI coming in weak helps support the position of dovish members of the FOMC, possibly providing the Fed with more time before tightening. Okay, so that's what's on deck. That's what's really important for today is the FOMC announcement, and then quickly we're going to switch over to the Scottish vote. Looking at the calendar today, at 9 a.m. Central, we have NAHB housing market expecting 56. At 9:30, expecting crude oil. The consensus is for negative 1.5 million barrels. Distillates 750,000 barrels positive, and gasoline negative 425,000. 1 p.m. FOMC rate decision expected at 0.25%. QE3 pace expected to slow down to 10 billion. MBS purchases for 5 billion and Treasury purchases for 10 billion. So drawing down from 35 billion to 25 billion on that on this statement. At 1:30 we have Fed Speaker Yellen having a press conference. The focus on here with this statement is on whether the Fed will keep the considerable time frame terms in today's statement or remove the phrase completely. So this is what we're watching out for. For that reason, the expectation is for the market to make some adjustments as far as risk. Money's either going to move in or out of risky assets, and then expect it to be choppy until 1 o'clock. Okay, let's look at what we did yesterday and where we are overall in the big picture. So, yesterday was actually very interesting. Yesterday played out exactly what was expected for Monday. Monday's plan was a day too early, I guess. Yesterday, the primary expectation, given the lay of the land, given the way the market had left us on Monday, the expectation was for responsive buying back towards 76, and then the expectation was to find sellers to continue on the trend that it's been on, and to take out the overnight low at 69, or the prior day's low at 69.50, and the expectation was for it to push into the 65 area. Instead, it opened and it had a very clean opening swing, so let's look at that. A very clean opening swing, open auction in range. Here it is. So we open and we have a nice open auction in range, test both sides, very clear where the sellers stepped in at 73.50 and very clear where the buyer stepped in at 75. So it looked like it was going to be a choppy sideways session, but that didn't hold for long. And then it broke through the opening swing, pulled back to the open or the mid, and then it immediately started to head for the 76 point of control and closing price for Monday. And then from there, the expectation was for it to turn back and start chopping with an upward skew. But what it actually did is it found buyers from down here, and buyers just stepped in and continued to push this thing higher. So there it is. It's taking out Monday's high. So clearly the buyers are in control. A small head and shoulders formation here. The expectation was for it to break down to 76, which is the mid closing price and the prior day's point of control again. And it's just not able to sustain sellers. So it does pull back, misses it by a tick, and then continues on. This is when I got the People's Bank of China news on the 500 billion yuan of liquidity being provided, and then immediately after we got this move here. So what we have here is a move from 76.50 till 85, pretty sizable rotation, and then immediately afterwards we get another 6-point rotation, and the 6-point rotation coincides with a comment by Wall Street Journal's Hilsenrath, who is a Fed watcher, stating that the Fed is likely to take a more dovish tone or cut back on the hawkish tone that they've adopted in the market. And you can see the reaction actually across the board, even in the Bund. If you look at the Eurex Bund, you see this move just kind of taking place to push lower, the Treasury move in the opposite direction generally to the stock asset class. Okay, so that's what we did. The goal was 94.50, and it hit it right on the nose. 94.50. If you saw it, I'm not sure you saw it in my charts yesterday. 94.50 is the value high of this composite right here, and the LVN left behind right here, 94.50 from this day. It is the point at which we started to sell off last week, And so as soon as we push through these highs, I start to go back in time looking for what I call template days, that we're looking at to see where the auction, the most recent or the freshest auction in the area took place. It's very important to be able to do that. And right now we're stuck in this template all the way up to 98.50, 98.25. And then from there, the next template day up is the all-time high at 2002 in the December contract. But yesterday, it ended up, we had a nice impulsive move here initially, and the first extension of that impulsive move was 94.50, and it aligned well with the LVN, the low volume node, from the day I just showed you, and the microcomposite volume value area high. So that was the target, and then the expectation was for it to roll back, but it didn't have much of a rotation back down given the size of the move up. So this is how we ended up yesterday. We have a trend day profile, double distribution, very thin in between. This is, you know, we pushed through the point of control, the microcomposite point of control, and just chopped around for just a short while. We didn't spend very much time there. The market had higher time frames in control, and just simply pushed through and continued to push through. So here's the move that pushed us into the microcomposite point of control, and pulled back to 86.50, just a point below it, and then just kind of chopped its way up for the rest of the session. So what does that tell us? It tells us that a higher time frame than the intermediate was actually active, was probably active in this with this move up. So with that being said, if we look at what it did overnight, really not much happened overnight. Nothing in the Asian session. It's recently, nothing has been happening with the Asian session. Nothing with the Asian session. Nothing as the European markets, which opened right here. Nothing with the European markets. It did create a new range, a full range with the European markets, but nothing really took place until we got to the CPI release. So with the CPI pushed us from 89.25 to 93.5, which is pretty much the entire overnight range. Very tight overnight, 4.5 points, 154,000 contracts. So what we have is some pretty decent consolidation. Inventory's balanced overnight, so no way for me to see or try to predict which way this may go, other than the fact that we had a higher time frame interacting on the buy side yesterday. So this morning, I'm going to be watching for a choppy open, and then I expect that money is going to move from one asset to the next. Yesterday, if you notice, the delta was a seller on the close. There was this buyer that came in. I've been talking about buying, persistent buying on the close. There's a buyer that came in and immediately was taken out and was taken down. So this is a market that's already prepping for to take risk off the table for the FOMC release. This morning I'm looking for more of the same, looking for the markets to balance things out, hedges and things like that, and then I expect it to chop around a little bit. My primary plan for today is to simply see what kind of an open we get, what the swings are, the opening swing high and low, and then measure the action based on that. Sellers can take this down to 85.25 or so and still not put a dent really in the buyers. Once it gets through here, it could float down very quickly down to 81.50, and then we're back into this distribution below. I would keep an eye on treasuries today, pull up the 10-year note and see what the curve traders are doing and what positions they're taking, because that will affect where the money goes before the FOMC announcement. Stephen Kelly during yesterday's webinar, the Convergence Tuesday webinar we had yesterday. Stephen Kelly talked about that a little bit, where liquidity moves from one asset class to the next in anticipation of risk on, risk off. So that's, I do have the treasuries set up here on a separate monitor, but as well as the European markets. So I'm looking out for that. I'm basically, for the key trade idea for the day, I'm basically going to see how this upper distribution is treated. In other words, we've traded quite a bit up here. We've moved the point of control up here on the close. The question remains, do we still see this as value? The overnight session did not have enough action to give us an indication. So we want to know, is this still value up here, or will it break lower and start to move back towards value down below? Will it get stuck at the point of the MC point of control? We see here a small high volume node was created yesterday against this large microcomposite that we have here, whose point of control is at 8750. So that's what I'm looking for. I'm not looking for any commitment by the market in any particular direction before the release. At the time of the release, so 5 minutes before the release, around 12:55 Central, 1:55 Eastern, you really need, if you have a position on, you either need to have some sort of a scale out to get to improve, to get some asymmetric risk, or to improve your risk profile, or you need to close your position. Expecting some high volatility today on the FOMC. Be watching very, very carefully. That's where the action is. I'm going to look for which side has the first move, what the corrective move is going to be like, and then if we get a continuation move from the first move, and then I'll be trading from that direction, whether it's down or up. I don't trade the first pulse. I don't trade the pullback, but I'm looking for the third leg. Where does that go? And then I'm going to look to trade from that direction. That is generally the more, the consensus is in the third leg rather than the first or second. It could have a first, and then the second could take back the first leg completely, and then pull back a little bit and continue with the second leg. I just want to see which side, after processing the news, which side actually commits money to the market. Is money moving out of the indices into treasuries and other asset classes, treasuries, gold, and so on, or is money coming into the indices to threaten this new high? Remember, the high from yesterday's high, the all-time high, was only about 7.5 points to 2002. So, and yesterday the Dow made new all-time highs. So we're, as I've been saying for the last few weeks, don't take the selling that has come into the market as an indication that the market is weak. This is very normal behavior, that we're pulling back inside of a balance zone. And the market needs to do that to accumulate the energy needed to make new highs. Did not see any failure here, did not see any reason to start thinking that the sellers are taking, or despite what I was hearing on CNBC and despite what was being said on Twitter, I think it takes a lot more to move this, to change the trend, than most people think. So we have quite a few perma bears at stage 5 who have just been funding their accounts to maintain their short positions. I hate to see that, but there's not much I can do about it. It's their money. If you're still short and want to stay short, I would strongly consider picking up some call options before volatility breaks out for some protection, for some insurance. I suggest you do that. If you don't know what you're doing when it comes to that, just drop me a line and I'll try to help you out. I'll leave you with that. Manage your risk early this morning. Make sure you have bullets to trade with when the FOMC comes out, because that's when the opportunity and higher risk comes in. I'll catch you in the afternoon when the announcement comes in, and I'll keep tweeting. Take care.